Hi everybody, welcome back to my accounting series. We're going to be doing accrual accounting concepts or adjusting the books today. So we're not only going to adjust the books, but we're also going to go back and review the first few steps of the accounting cycle, because I want to show you guys today how the cycle fits in. So how we start from step one all the way to the finished product, which will end up with closing entries today. So in order to do that, we're going to work through an example of a business. What better way to do it than to work through an actual example here. So we have a fictitious company called Cafe Crazy that we're going to go through a month's worth of transactions, and we're going to analyze and we're going to journalize using debit and credit techniques. So the very first entry would be January 1st. They issued $9,000 of common stock for $9,000 cash. So first we have to ask ourselves, what two accounts are involved here? Well, we know common stock and cash. What's going on with them? Is cash going up or down? What's going on with common stock? Well, cash is increasing, right? We're receiving $9,000 cash. What type of an account is cash? Well, it's an asset. What's the rules for asset? When assets increase, we know to debit cash, right? So to debit cash for $9,000. And we know the common stock is a part of equity, and equity is increasing. When equity increases, common stock goes up, we're going to credit the account common stock. So our journal entry on January 1st will look like this. We have our date, January 1st, and we have a debit to cash of $9,000 all the way written to the left, and then the credit indented to the right of common stock for $9,000. All right, the next entry, January 1st, purchased high-quality coffee and espresso machines for $6,000, paying $3,000 cash and the balance on account. Okay, so what accounts are involved here? I see way more than just one. I see, okay, we're buying a piece of equipment, a machine for $6,000. We're paying cash, so cash involved, and we're paying a balance on account. That means we're incurring a debt. So what's going to be our journal entry? Well, the machine, the coffee and espresso machine is an asset. It's going up. We're acquiring an asset for our company. So the very first debit here is going to be to equipment for $6,000. Now, the corresponding credit here is going to be a balance. We're going to owe what? Owe $3,000 on account, because $3,000 cash minus $6,000 is $3,000. So we're going to credit or decrease our cash account by $3,000 because our asset cash is going down. And we're going to create an account payable, which is a liability for $3,000 as well. So this entry here is known as a compound entry because we have more than two accounts. That's why it's compound. There's three here. Okay, our next entry on January 3rd, we purchased cups, logo, napkins, straws, etc. for $900 on account from Java Junk. So what is this? We actually are buying supplies, right? Supplies for our company for to operate the business. Supplies for us as a coffee shop would be an asset, okay? They would be an asset. And they were buying them on account, which means we are creating a debt. We're going to create a debt or a liability called accounts payable. So the entry here would be to debit supplies for $900. Our asset supplies are increasing. That's why we debited supplies. And we're going to credit accounts payable, which we're increasing a liability for $900 as well. Okay, the next transaction, January 5th, paid $1,200 cash on 1-year insurance policy effective January 1st. Okay. We know cash is going down because we see the word paid. Paid cash, that's an asset going down. That's going to be a credit. But what's my debit here? Well, we're going to call a 1-year insurance policy a prepaid asset because it's an asset that we're buying up front that's going to expire over a year. So we're going to debit prepaid insurance for $1,200, and that is an asset to us until it expires. The credit then would be to decrease cash by $1,200. right, January 12th, billed caffeine addicts $2,500 for coffee purchased on account. This looks like a revenue transaction, but what kind? When we bill a customer, we're going to create what is known as an account receivable because they're not paying us the cash right away. They're going to pay us the cash later. So our debit here is going to be to increase an account receivable for $2,500, which is an asset. And our credit is going to be to earned cafe revenue. We actually earned the money, so we're going to increase the revenue account by $2,500 as well. Now, January 18th, we paid $1,000 cash on amount owed on coffee machines and $500 on the amount owed on cash supplies. So it looks like we're paying off a debt here, and we're paying cash, so cash is going down, so that's going to be a credit to cash. What would our debit be? Well, our debit's going to be to accounts payable, which is decreasing accounts payable because it's a liability by the $1,000 plus the $500 for a total of $1,500. So to decrease a payable, we debit that. And then we're going to credit or decrease our cash account by $1,500. Now, January 20th paid $1,200 cash for cafe employee salaries. Here, we're paying our workers. We're paying cash, so we know it's going to be a credit to cash. What's my corresponding debit? Well, this is going to be an expense. We're going to call that salary expense. Increasing an expense is a debit. And then we're going to credit or decrease cash, $1,200. All right, January 21st, collected $1,400 cash from the customers billed on January 12th. So here, our customers are paying us what they owe us. We're not earning any more money. We already recognized the revenue from the January 12th transaction. So here, we're increasing our cash, increasing our asset by $1,400, so we will make a debit. Our credit then would be to decrease the other asset, accounts receivable. So here we're increasing an asset and we're decreasing an asset. They no longer owe us the amount, so we're going to decrease their receivable, their corresponding customer receivable of $1,400. On January 25th, we're billing cafe customers $2,000 for purchases on account. So here's another revenue transaction. The same kind we dealt with on January 12th. So here we're going to increase accounts receivable, the bill, okay, for $2,000, and we're going to increase our revenue. We're earning cafe revenue, a credit of $2,000. January 31st, paid electric bill for the month, $200. Here is an expense, right? Utilities expense. We're going to increase utilities expense $200 by making a debit. We see the word paid, so we know cash is going down. We're going to credit cash. All right, the last entry for the month, the normal transactions here. January 31st, declared and paid a $600 cash dividend. We can pay dividends as long as we have sufficient cash. So we're going to debit dividends for $600, and then we paid them, so we're going to credit cash for $600. So those are some normal transactions. Again, the transactions vary by company. This is just for one particular company. This is a coffee shop. So what would we do next? After we journalize, we know we go to the general ledger and then we post the transactions into the individual T accounts. And then we take the balances in those T accounts and pull them to form a trial balance, which is here, to see if we journalized and posted correctly. So right here, I'm going to list for you a trial balance as of January 31st, 2002, with all the accounts that we used in the journal process, and they're ending either debit or credit balance. Okay, after we have done all the posting into the individual T accounts, that tedious process. So cash has an ending debit balance of $2,700. Account receivable has an ending debit balance of $3,100. Cafe supplies, ending debit balance of $900. Prepaid insurance, an ending debit balance of $1,200. Cafe equipment, ending balance of $6,000. Account payable, ending credit balance of $2,400. Common stock, ending credit balance of $9,000. Dividends, ending debit balance of $600. Cafe revenue, ending credit balance of $4,500. Salaries expense ending debit balance of $1,200. Utilities expense ending debit balance of $200. And then we would add up the debit column and add up the credit column, and they have to balance. And they do here, $15,900 on both sides. This is our checkpoint, okay? Now we know, hey, we can go ahead and prepare the financial statements. But wait, what if your company uses the accrual-based method? You can't do it yet. There's one more step, and that's called adjusting entries. So what's the difference between accrual basis and cash basis? The accrual method is used by most companies for reporting purposes because it gives a better representation of what's going on with the company. And since most publicly traded companies use it, you have to in order to compare your results with others. The cash method is less complex, and it's used by some very, very small mom and pop type companies, okay? So if you're a large company, chances are you're going to be using the accrual-based method of accounting. So what's the difference? So let's take 2 years. Year 2001, our company purchased paint, painted a building, and paid employees. Under the accrual method, we're going to match revenues with the expenses. So we're going to say we earned $80,000, we had expenses of $50,000, which gave us net income of $30,000. If we were using the cash method, we didn't actually receive any money this year. Does it say we received money? No. But we incurred expenses. We had expenses. We paid employees $50,000. So if we were using the cash-based method this year, we would have shown a net loss rather than a $30,000 net income. And then you go to year 2002. We received the payment for the work in the year 2001. So under accrual, you wouldn't recognize anything. You wouldn't recognize a revenue or expense. But under the cash basis, you'd have $80,000 of revenue, no expenses, and $80,000 of net income. So you can see how it distorts net income if you use the cash basis compared to the accrual basis. Because under the accrual, it shows us we actually earned $30,000 in year 2001 and nothing in year 2002. Whereas the cash basis is screwing with the results here. Accrual manipulation. Now, adjusting the financial statements is the goal, but a lot of times this is an area where companies actually adjust the books to fit their own needs. So as an auditor and as an accountant, you have to be careful. This is a risk for fraudulent reporting. So for example, pressures to meet earnings projections for the year end. Managers may, shift expenses to the next year, recognize revenue too early in order to boost net income. Okay, this is not right. This is fraud, and it's illegal. So how and when do we accrue? According to GAAP, we have 2 rules that guide us in our adjusting process. The revenue recognition principle is the first one, and this one says that we recognize revenue in the period we earned it, not when we received it. So every company is different as to when is earned. So for example, a service company, when the service is performed, that's when it's earned. A merchandising company, when the merchandise is sold. And a construction company, usually it'll vary when the project's complete or at certain stages of the project. And then the other principle is the matching principle. This one says we should match expenses with the revenues that generated them. This is why we're going to say, hey, our sales for January are going to be reported with our expenses for January. We don't want expenses from June to be matched with sales from January. So let's learn how to accrue or adjust the books. So if you remember, if you watched my previous lecture, we learned the recording process, the analyze, journalize, post, and then the trial balance. There are several more steps to the accounting cycle to learn, and adjusting is step 5, which consists of all the adjusting journal entries and then posting the adjusting journal entries to the T accounts. The last statement here is very important. Adjustments are required every time the financial statements are prepared if the company is using the accrual basis of accounting. So if they need to prepare financial statements, in the middle of July, they need to adjust the books before they prepare the financial statements. Okay, we're going to group our adjustments into 4 categories as we learn them. Okay, we're going to call them prepaid expenses, We're going to call them accrued expenses. We're going to call them unearned revenues and accrued revenues. Okay, this little statement here, very important. Every adjusting journal entry will affect at least one balance sheet account and one income statement account. So if you're making an adjusting entry and you have an asset and a liability, that is wrong. It has to be one income statement account and one balance sheet account to be an adjustment. And cash is never used in adjusting entries. All right, so what are prepaid expenses? These are expenses that we pay for, but they're not used yet. So these are assets and they're reported on the balance sheet with a normal debit balance, like prepaid insurance, okay, prepaid rent. Examples include supplies, insurance, rent. When these assets are used, we must expense them. And we do that through the adjustment process, okay? If you're looking at an adjusting entry, the word ADJ is before the date to signify that it's an adjusting entry. So here we have a debit to supplies expense of $1,500 and a credit to supplies of $1,500. So we're increasing supplies expense, which is an income statement item, and we're decreasing an asset supplies, which is a balance sheet item. So that's what it is. We used up our supplies for the month, so we're decreasing our supplies by crediting the account and increasing our supplies expense. Okay, the depreciation adjustment is kind of all by itself. I used to say it's kind of like a prepaid, but it's more or less its own category. So what is accumulated depreciation? We're going to learn what that is. But accumulated depreciation is a contra asset reported on the balance sheet because it is a subtraction. So that's why we hear the word contra. So if it's on the balance sheet and you have your assets listed and there's something deducted from an asset, it's a contra asset. Okay, that's all that means. All contra assets have normal credit balances, which would be opposite of assets. That's why it's a subtraction on the balance sheet. So as time passes, the assets that we have, which are depreciable, such as vehicles, buildings, and equipment, they have to be written down. So we do this during the adjustment step, and once calculated, the entry looks like this. We would debit depreciation expense and credit or increase accumulated depreciation. So accumulated depreciation increases, therefore it is credited in a normal credit balance. At any time, the book value can be calculated by taking the original cost of the asset minus whatever the balance is in accumulated depreciation to give you the book value of that asset if you wanted to sell that asset or so forth, get rid of it. Okay, so the second group of categories are my accrued expenses. These are expenses incurred but not yet paid. Okay, so we have incurred them, but we haven't paid them. Accrued expenses are expenses reported on the income statement as accrued, resulting in a corresponding payable account. So that would be your corresponding balance sheet account. So examples include interest, rent, taxes, salaries, etc. So let's say we borrowed money and interest is due in 3 months on a note. Well, each month we need to record a portion of the interest as an expense. So for example, $5,000 note at a 15% annual rate. 5,000 times 0.15 times 1/12 gives us $63 per month of interest that we would need to accrue. Okay, so the adjusting entry for this would be to debit interest expense for $63 and to create an interest payable account for $63. So that would be my liability account. And that would be the adjustment for that month. Or you can do it for a quarter or for a year. However long you need to accrue it for, you would adjust your calculation there. So another example that would fall under accrued expenses would be salaries, accrued salaries, because payday doesn't always fall on the very last day of the month. So a business pays its employees approximately $4,000 total every other Friday. For the month of February, payday fell on February 8th and February 22nd, which resulted in $8,000 total cash paid for the month. But what happens here, the employees work the next week between February 25th and March 1st, but they won't get paid again until March 8th. But to match revenues with expenses for the month of February, we have to calculate and accrue the portion of their salaries earned February 25th, 26th, 27th, and 28th. So for 4 days, okay? If we're going to prepare the financial statements at the end of February, those 4 days of payroll have to be calculated. So let's figure it out. These workers have a 5-day work week and get paid every 2 weeks. Therefore, by the day, they earn $400. How do we figure that? Well, they said they earned $4,000 total. That's divided by 10 days. Therefore, they earn $400 by the day. So, to properly accrue the salaries for the month of February, the adjustment would be as follows. To debit salaries expense for $1,600, how do I get $1,600? Well, that's $400 a day times 4 days. And then I would create the salaries payable, and that would be a credit for $1,600. Okay? And that would be my adjustment on the book for February to go ahead and properly match my expenses with my revenues for February when I went ahead and prepared the financial statements. And of course in March, I would decrease the payable and pay out the cash when I mailed their paychecks. Okay, the third type of adjustment is an unearned revenue. This is cash received but not yet earned. And it's very difficult for people to understand that an unearned revenue is a liability. So their liabilities are reported on the balance sheet with a normal credit balance. Examples include rent, magazine subscriptions, airline ticket sales. So the adjustment is going to be made for the portion that we earned that period. Okay? What did we earn? So here's an example. If we lease apartments, a tenant may pay for a year in advance on January 1st. They're going to give us $500 per month for 12 months, so they're going to pay us $6,000 at the beginning of the year. So on January 1, we're going to receive $6,000 cash. This is not an adjusting entry because we're using cash. This is a normal entry. And we're going to credit unearned revenue for $6,000, okay? Because it's a liability. They're paying us and we owe them a service. We owe them, the time in the apartment. So at the end of the month of January, when we went to, go ahead and prepare our financial statements, the adjusting entry that we'd have to make on our books for this particular entry would be to debit unearned revenue for $500 for that 1 month. We're going to decrease the unearned revenue account, and we're going to move it into an earned revenue account, $500. So we're going to decrease the liability and put that $500 into our earned revenue. And that would be the adjustment for earning the particular portion of the rent for that month. And that is an adjusting entry. So that would decrease the unearned revenue account to $5,500. 6,000 minus 500 to give us $5,500 going forward. Okay, the fourth adjusting entry is accrued revenues. These are revenues that we earned, but we haven't received. These are those receivables. These are those bills when we mail out our bills. So it's going to result in a corresponding receivable account. So examples include interest, services performed but not yet billed. So an example of an adjustment here would be to debit accounts receivable. Okay, that is going ahead and billing the customer, increasing the asset, and then crediting the revenue account. And we've seen this as a normal transaction. It can be an adjusting transaction or a normal transaction during the month of business. Or we can do interest. When we want to accrue interest, interest receivable, and we have interest revenue, the credit. Okay, so those are the entries, the adjusting entries, the most common ones. Now let's go back to our example and do the adjustments. So cafe catering services provided but unbilled and uncollected at January 31st was $1,100. Well, here is write-off a receivable transaction. So our adjustment would be to debit accounts receivable for $1,100 and then credit or increase the revenue account by $1,100. Depreciation on the coffee machines for the month was $200. Here's our depreciation adjustment. We would debit depreciation expense $200 and credit the contra asset accumulated depreciation. 1/12 of the insurance expired. We would debit insurance expense $100 and we would credit prepaid insurance $100. How do we get $100? Well, when we bought the insurance, we paid $1,200 for the insurance, which means if we're going to buy it for a whole year, 1,200 divided by 12 means $100 of it has expired at the end of the month of January. An inventory count shows $600 of cafe supplies on hand at January 31st. Okay, so how much was used? Well, we'll have to calculate that out. We bought 900, there's 600 left. That means we used 300. So the amount on hand at 131 would be 300. To debit supplies expense of 300 and credit supplies of 300. The last one, accrued but unpaid salaries, were 400. Here we would debit a salaries expense for 400 and credit salaries payable, the liability, to go ahead and accrue the salaries for the month. So after you journalize all the adjustments, you have to post these adjustments to the T accounts in the ledger. And then from those accounts, you prepare another trial balance and then the financial statements. I hope you'd enjoy my lecture today, and please, tune in for more, comment and like, and subscribe to my channel. Thank you so much.